Investors are beginning to concern about the valuation of the market. We can see through this chart published by JP Morgan of the S&P 500 index in the forward price to earnings ratio. As of October 31st, 2025, it sits at 22.9 times earnings. This is significantly above the 10-year average of 18.6 times earnings, as well as above the 30-year average of 17.1 times earnings. Now, this can definitely raise some concerns for investors. As the price to earnings ratio goes up, many investors start to believe that the market is overvalued. Now, in some cases, it definitely could be overvalued. A lot of companies have started releasing their quarter 3 2025 earnings, and some have come out not that great. I made a previous video on Meta and showed how they had a significant miss on their EPS. But that's really due to Meta spending a lot on capital expenditures. Michael Burry grabbed the attention of a lot of investors this past week as his hedge fund, Cyan Asset Management, put out large puts against Nvidia and Palantir, basically shorting their company. Alex Karp, the CEO of Palantir, went to CNBC and had some bad words for Michael Burry. Alex Karp put it, the two companies he's shorting are the ones making all the money, which is super weird. The idea that chips and ontology is what you want to short is bats shit crazy. Clearly, the market is definitely sitting at a high forward price to earnings ratio, but I think this is somewhat justified. Really, the only way this is justified is through strong future earnings. We can see that the year-over-year growth rate for earnings in quarter 3 of 2025 is 10.7%. From this chart, it's a steep incline. Now we can see from this chart, which projects the future earnings from quarter 3 2025 all the way to quarter 4 of 2026, showing that there could be a slight decrease in quarter 4 of 2025, which could start to not justify this high forward PE ratio, but then it starts to increase, and in quarter 4 of 2026, it sits at 15.9% exponential increase. I believe that maybe the market is a little bit overvalued right now. I think that it'll have that correction and rebalance from quarter 4 of 2025 as earnings growth starts to decrease, but from there we can start to see an exponential increase through quarter 4 of 2026. So I actually just made a trade in Netflix, which I figured I would show you guys. And in this overvalued market right now, it's hard to find value stocks. I'm a value investor, but I have 3 different portfolios where I have different investment strategies, which I figured I'd show you. So the first one is the Deep Value Fund. This is my value investment strategy. So I made a video a while back on NU Holdings, which is a fintech company out of Latin America. It was a great value investment, bearing out a 15.15% return. And then Antero Midstream, which is a gas and energy company, which was a value investment play, and I made an 18.33% return out of them. The only one that I held onto was Bowhead Specialty Holdings, which is an insurance company, very undervalued. Its IPO was only a couple years ago, so it's a new company. Unfortunately, a large institution came and started sharing a large portion of their shares, which really drove down the price. Fundamentally, they still look really strong, and I'm going to continue to hold them. Next is my Haven Fund. This is all my safe investment. My total gain, I'm up 0.74%. Unrealized gain, 4.82%. Now, in this, I have DIA, which is a Dow Jones Industrial Average ETF, pays out a monthly dividend, and I'm up 10.45%. Making sure to diversify your portfolio into safe investments such as some ETFs can be a very good play depending on your portfolio theory. And then I have the Charles Schwab US Dividend Equity ETF, which I continue to put money into. This pays out a quarterly dividend. Now, the Charles Schwab I don't care too much about in terms of growth, but their dividend, I want to continue adding shares into the company so that I can get a strong quarterly dividend. Now, for my Summit Growth Fund, this is all long-term growth investments. I'm up 4.55% for unrealized gain, and total gain 17.98%. I talked about this earlier on my channel, but I made a short-term investment in Nvidia, 15.26% gain there, and then I continue to hold Apple, which has bared out a 13.97% gain. And then I just recently added shares into Netflix. So my whole thesis around the Netflix play, first, I think it's a great company to invest in, great future growth, great fundamentals. I also think it's just a good investment in the current market environment. Like I discussed, it's hard to find value plays right now. Netflix by no means is undervalued, as I'll show, but it's a great growth investment. And I've started to focus more on long-term investments and growth investments in this somewhat overvalued market. So just to begin, Netflix is such a powerhouse in the streaming industry, and they have a large geographical region that they, stream out of. And, their marketplace is so huge, it's around the world. The Stranger Things finale is coming to Netflix and select theaters for fan events. Now, this will be a huge revenue opportunity for Netflix, as all these people are going to be talking about this for the end of the year, and families from around the world are going to be sitting down and watching this show. Not to mention their super popular movie here K-pop Demon Hunters. People are talking about it constantly. So, Netflix has these select movies and shows that you can only see on Netflix, making people go to Netflix rather than other streaming services. So Netflix just reported earnings, and they actually had a revenue miss. Netflix came out and blamed this on a tax dispute in Brazil for their rare earnings letdown. This drove down the share price like crazy, as investors didn't really fully believe Netflix in blaming this revenue miss on a tax dispute in Brazil. They believed that there was another underlying condition that Netflix was not sharing. Now, this earnings miss definitely isn't a good thing about Netflix, although all their trailing 12 months numbers for 2025 are on par for having percentage increases in revenue, net income, gross profit, so they're still on track. Really, the only negative thing about Netflix right now is that they're a little overvalued. Currently, their price to earnings ratio is sitting at 45.89. The PE ratio for the S&P 500 is 30.69, so a little bit higher, and in terms of that, you could suggest that Netflix is overvalued. They're also somewhat overvalued in terms of their forward price to earnings ratio, which is sitting at 43.39. Now, I think this high forward price to earnings ratio, as well as their current price to earnings ratio, is very justified. 2024, their diluted earnings per share was 19.83. Trailing 12 months, they're at 23.94%. They're on par for releasing a very positive diluted EPS for 2025. Their revenue has seen great growth from 2018 to 2024 and even before 2018. From 2019 and below, they were focused more on international streaming, domestic streaming, and DVDs. Now the business has shifted to just streaming, and in 2024, they had revenue of $39 billion for their streaming segment. And like I stated, Netflix has such a huge geographical region where they operate out of. You can see here, they operate from the United States, Europe, Latin America, Asia Pacific, and Canada. And since 2018, that revenue has been growing. Netflix also has a huge amount of free cash flow. In 2024, $6.92 billion. Trailing 12 months, they're sitting at $8.97 billion. And they return a lot of this value back to the shareholders through a stock repurchase program. In January 2025, Netflix boosted its share repurchase program by $15 billion. Netflix has a very high operating margin percentage, 29% currently. Netflix is very efficient in converting its revenue into operating profit due to its low operating expenses. Some of its other peers, such as Warner Bros., Discovery, and Paramount, are showing improvements in their operating margin percentage, but still lag behind Netflix. Netflix holds such a huge market share, their expenses are low, and their profitability is very high. I mentioned this early on in my thesis and why I'm investing in Netflix, but their growth rate is tremendous. Revenue growth forward 14.75%, and the sector median is 3.37%. We can also look at their earnings per share diluted growth forward, which is sitting at 38.98%. There's definitely other companies that I think are great investments too right now, which I'll elaborate more on future videos. But Walmart, you're getting it at a discount, had this little bit of a pullback. Just made this new deal with OpenAI, and great growth, great fundamentals. I also really like Microsoft right now. It's under that 200-day moving average. Also great growth, great fundamentals. You're getting it at quite a discount compared to, where the market's sitting at right now. So as I make this video, the major stock indexes are seeing quite the pullback. Now this is really due to the tech-led sell-off as investors weighed signals on the job market and the odds that the AI investment boom will pay off. Now the only job data that we were able to get due to the government being shut down with the ADP job report. NBC News stated analysts surveyed by Dow Jones expected the ADP report to show that 22,000 jobs were added in October, a sharp reversal from the 32,000 jobs shed in September. Now really the whole thesis behind the Fed starting to cut rates is due to this weakening job market, and I made a video on that, which you should definitely go check out. But it seems that right now, with everything that's happening in the economy, with the government shutdown, these rate cuts haven't really played any significant factor. And when this ADP job report came out, it didn't show any signs of growth in the job market, and investors really start to become wary. So I think this correction is a good thing. It's certainly not long-term. I think that the market will be able to recover by the end of the year. Earnings for this quarter look somewhat strong and justify the current forward price to earnings ratio. As we saw from the projected price to earnings ratio for quarter 4, that high forward PE ratio, if it stays the same, will certainly not be justified, and we could start to see another pullback during that period. I definitely think the AI industry will certainly pay off over the long term. Many times the market just runs on this short-term speculation, as we're seeing right now. Many investors start to become fearful, but that's a great buying opportunity for me, and it should be for you. You're getting it at a discount. The market will definitely recover. So as we move through the end of the year, I think another pullback could be in the horizon, like I said, with the low earnings per share growth that is projected for quarter 4 of 2025, and the Fed still have one possible rate cut in December. So if you guys haven't already checked out my Discord channel, make sure to join. Everything's completely free. I'm going to be posting economic news, stock market news, my insight on the stock market and what's going to happen in the future, my trades, any value investments, growth investments, and there's also a community chat, so definitely make sure to go check that out.